All right, let's get right into this explainer. We're going to trace the actual fascinating journey of a purchase, from the exact moment a company realizes they need something all the way to the final update in the general ledger. Whether you're an accounting student or just someone who wants to understand how a real business controls its cash, this is absolutely for you. We're going to look at the exact mechanics of how a company acquires goods, pays for them, and make sure not a single cent is lost along the way.
To make this complex cycle crystal clear, we'll follow a real-world scenario with a company called Coco Fashions. Here's our agenda for today. 1. The purchasing cycle overview. 2. The essential documents. 3. Going digital with ERP systems. 4. The step-by-step process flow. And 5. Local versus foreign suppliers.
Starting with Section 1, the purchasing cycle overview. Let's take a high-level look at what this cycle actually aims to achieve in a real business environment. So the crucial takeaway here is that this isn't just about going out and spending money. It's a tightly controlled operation. A business like Coco Fashions has to get exactly what it needs to manufacture its clothing. It's an integrated system, right? We need the correct quality fabric at the absolute best price, arriving exactly when the production floor needs it. And we have to ensure we only pay the legitimate supplier for exactly what we received.
Now, what's really interesting about this is that every step we'll discuss is designed to hit these specific core control objectives. This is how you prevent fraud and errors. Management wants validity, meaning only real approved purchases actually happen. They need completeness, so no liabilities are hidden away. They require accuracy in the amounts. They need proper cutoffs so expenses are recorded in the correct time period. And of course, they have to physically safeguard their assets, like that expensive fabric sitting in the warehouse. Moving on to Section 2, the essential documents. You literally can't have controls without a paper trail, so let's look at the essential documents that act as the physical lifeblood of the cycle. It all starts right here with the purchase requisition, or PR. This is an internal document. The warehouse or the production team doesn't just pick up the phone and call a supplier. Instead, they fill out this form, requesting the items based on their sales demand, and hand it over to management. And this brilliantly illustrates the separation of duties. The people who actually need the goods aren't the ones buying them. The purchasing manager steps in. They take that approved requisition, source quotes from various suppliers, usually a minimum of 3 to ensure it's cost-effective, and only then do they generate the official purchase order, the PO, to send out to the chosen supplier. Fast forward a bit. The delivery truck rolls up to the receiving area. The warehouse team takes the supplier delivery note and checks it against a copy of our original PO. They count the fabric rolls, check the quality, and if anything is wrong, they reject it right on the spot. For the goods they do accept, they create an internal goods receive note, or GRN, officially logging the exact quantities brought into the building. Now let's hop over to the accounting side. The arrival of the supplier's invoice triggers the financial recording. We now officially owe money. The accounting department uses the invoice to update the creditor account, the accounts payable. Simultaneously, the inventory master file gets updated to reflect the new cost of the materials we just brought in. Finally, we reach the payment stage. Funds only leave the bank via an electronic funds transfer, or EFT, after a really strict matching process. Before any money moves, accounting makes sure they have a matching PO, GRN, and invoice. Once that's approved, the EFT is sent to the supplier alongside a remittance advice. That's just a simple document explaining to the supplier exactly which invoice this payment is covering. All right, Section 3, Going Digital, ERP Systems. Let's see what happens when we replace manual paper pushing with a computerized environment. An enterprise resource planning system, an ERP, fundamentally changes the game. It connects the warehouse, purchasing, and accounting departments into one real-time database. Instead of walking physical pieces of paper from the factory floor to the finance office, every single action is logged into a unified system where everyone has instant, real-time insight. And the real magic here is the three-way match. In a manual system, a clerk could easily make a mistake or overlook a discrepancy between the PO, the GRN, and the invoice. But an ERP system mathematically verifies that the quantities ordered match the quantities received, which perfectly match the quantities billed. It basically prevents overpayments without any human intervention. Section 4. Step-by-step process flow. Let's bring all of these concepts together and walk through the full end-to-end integrated flow. Our journey begins when Coco Fashions predicts a huge sales demand. This triggers the approved initiation of the order. The production manager prepares the requisition. The purchasing manager receives it, reviews why they need it, sources the best quote, and formally issues the digital purchase order to the supplier. Now, I want you to pause and ask yourself at this stage, is this a valid business expense? And who actually said yes to it? By ensuring the production manager requests it and the purchasing manager approves it, the company completely locks down its validity control. This is exactly what prevents an employee from using company funds to order a new flat-screen TV for their house. A few days later, the physical fabric enters the warehouse. It's counted, it's inspected, and the warehouse team logs the goods received note. Now, because Coco Fashions uses an ERP, the digital system immediately and simultaneously records the new inventory valuation on the balance sheet and recognizes the money owed to the creditor based on the incoming invoice. Here is where accuracy is really tested. What if the supplier shorted us on fabric? Say they sent 90 rolls instead of 100. Well, the warehouse team has to catch it on the GRN. Because the ERP relies on that three-way match, the GRN of 90 rolls will instantly flag the supplier's invoice of 100 rolls, ensuring we don't accidentally pay for fabric we never actually got. At the end of the month, the finance department prepares the payments. The system performs the three-way match, authorizes the EFT, and sends the remittance advice. Crucially, these highly controlled transactions flow seamlessly right into the general ledger, reducing our cash balance, clearing the creditor account, and finalizing the cost of goods received. And remember, digital controls mean absolutely nothing if physical inventory is stolen right off the warehouse floor. That is why physical security, like the cameras used by Coco Fashions to monitor the receiving area, are a core, non-negotiable part of the cycle. You have to protect the physical assets just as tightly as the digital records. Okay, Section 5, Local versus Foreign Suppliers. Before we wrap up, we have to address a major real-world complication: buying from overseas. When Coco Fashions buys fabric internationally, the ERP system and the accounting team suddenly have to juggle a bunch of new variables. Instead of simple domestic currency, they faced foreign exchange risks, where the cost might fluctuate before payment. They also have to account for complex landed costs, like import duties and freight. And instead of just a standard invoice, they have to process customs declarations and bills of lading. The basic principles remain the same, but the execution becomes significantly more complex. Ultimately, the entire purpose of this beautifully structured cycle is to ensure the general ledger is absolutely flawless when audit time comes around. Whether you are dealing with a local supplier down the street or a foreign manufacturer across the globe, every single transaction must hit those control objectives before it ever alters the company's financial statements. Now, I want to leave you with this to think about. As our systems become more automated, more integrated, and entirely frictionless, where do the new vulnerabilities hide? If the computer does all the matching perfectly, how could a bad actor still manipulate the purchases and payables cycle? It's something every great auditor must consider. Thanks so much for joining me on this explainer today.